There we go. So good morning, everybody. Sorry for the technical difficulties. We had a little bit of a problem there, but I'm glad that you held on and were able to join us. And I'm hoping if anybody has any difficulty, just let me know in the chat. So thanks very much. Robert Brancatelli and with Dennis Kushner. Dennis is on audio. I don't think we'll be able to see him unless that changes during the course of the presentation, hopefully. And this is Fordham Road Collaborative and the Kushner Report. I want to say a couple things. One is that welcome, especially those of you, if this is your first time, we welcome you to this financial and economic report. And this is being recorded. The presentation will be recorded and not the follow-up Q&A, as you know. And our next time that we do this will be January 27th. So it's going to be a little bit of a while. We wanted to do this now, obviously, because of the issue with Thanksgiving. So let me, that's our fordhamroad.net. Those are our email addresses. And this is the Kushner Report. Again, if you go to the website, as you know, you can go to the website and download the recording of the presentation should you want that. And that's Dennis there. The other thing we wanted to do is to just, this is us over the course of a few months. We've covered quite a bit of territory, and you know, Dennis and I were talking about this, just the number of topics that we've gone on the Kushner Report. Dennis, do you want to give them a rundown of just some of the things?
So let me tell you what we've covered this year. Starting in January, we started out with underlying assumptions, which I plan to do as we get into January, as we have a new year coming up. We talked about mergers and acquisitions and divestitures. We talked about the venture capital outlook for 2020. Talked about regaining our edge in the chip manufacturing technology and also about commercial real estate. Then we took a look at the oil and gas industry and venture investments in the second quarter, and also the issues beginning to surface around semiconductor chips. Then we talked about what lied ahead, for example, in the area of biotechnology and retail sales. We covered the area of artificial intelligence and the technology sector. And then when we moved into September, we talked about transforming the solar energy outlook. And then in October, we were able to talk about ransomware. And then today we're going to talk about supply chain. And of course, we're not going to have a program in December. We'll take the time off. And then in January, we should have a lot of information in terms of maybe what transpires at the end of the year, for example, what happened at the end of the year, and then what we're looking for economically going into 2022. So that's the target for what we did this year. So we accomplished a lot. And what I try to do is have one specific subject that we can talk about in addition to just finance and economics. So that way we can cover some different things. And if any of you have any topics you're interested in, you know, just send me an email. We'll take a look at those for next year. So let's get started. First of all, welcome everyone to the Kushner Report for November of 2021. And at the conclusion of today's presentation, we'll have an opportunity to participate in questions and answers. So hopefully you'll be able to participate today.
Okay, so Dennis, I'll let you know since you can't. Oh, you can see the you can see
everything
us.
except
Okay, perfect. Okay, perfect. So I'll just run the slides then for you. Okay, so go ahead.
Okay, so Bill Swan, I want to see a smile on your face. Better. Okay. So today, here's the agenda for today's presentation. We're going to talk about key economic indicators, the global economy, the domestic economy, mergers and acquisitions, which has been a lot of activity this month, other significant economic news, and then what's ahead in 2021. So the real issue right now is supply chain, which is having a major effect not only on our economy, but also around the world. Now, what I'd like to start out with is look at the gross domestic product, inflation, unemployment at the federal level, the California level, and also the price per barrel of oil. So let's take a look at, and what if you look at the stars to the right of the percentages, those are that's the data that changed since our last presentation. So first of all, the global GDP going out the end of 2021 still looks to be strong at 5.8%. And then they're looking at 4% next year. We look at the United States, we're looking at 5.5%. And then next year, we're dropping down to 4.1%. As far as inflation goes, we raised that up this year because it's looked like on an average, it'll go out about 5.1%. And I'm going to talk more about that later in the presentation. And then inflation next year is going to go up again at 5.2%. The unemployment rate on a federal level is running at 5.5%. Go back. 5.5%. And then if we're looking at unemployment next year, it should drop down to 4.3%. And again, I'll talk about this later, but typically if we're around 3.5% or lower, it really resonates into full employment. And then we're looking at the California unemployment picture, and it's still around 6.5%, and it may even be higher than that by the time we go through November and December. And then next year, we're looking at 5.1%. In the area of oil, the prices have been going up and down all year long. You know, we had it very low early in the year, and now we saw it. It's probably somewhere close to $85 a barrel by the time we end the year. Okay, next slide. So let's take a look at what's happening globally. So first of all, in the global marketplace, Canada is ending its quantitative easing, basically, and they're going to start raising interest rates in their country. So we're looking at probably a 0.25% increase in their funds rate, and that's going to take place sometime over the next few weeks. So they're starting out ahead of us. If you look at the Russian ruble, it's back on top again as a performer. You know, following a year where the ruble was one of the worst performing emergency currencies around the world, it's basically reversed its course of action since 2020. Now, the Central Bank of Russia has been one of the most hawkish central banks in the world this year. And the key is the price of Brent crude is up 64% over the last 12 months, which is substantial. And basically, their ruble has increased 5% against the US dollar. So you're seeing that taking place. Keep in mind, the Russian economy is really predicated on oil. And as the oil prices continue to go up and escalate into higher levels, their economy will get stronger. China continues to struggle. You can see here we're talking about further slowing. Basically, overall data was mixed, indicating that China's economy is still broadly decelerating and should still face headwinds in the coming months from COVID-related restrictions, enhanced regulatory scrutiny, and also a slowdown in the real estate sector. And there's been a lot of talk about the real estate. China's real estate sector is really under significant pressure. Recent data indicated that home sales continue to slow and weigh on economic output. And while we expect some more systematically important Chinese property developers to continue to struggle making bond repayments, and we talked earlier, there's probably 150 to 170 banks within China that could go into the real serious economic problems if the bond payments are not repaid. That could be a very bad situation for the Chinese economy going forward. The United Kingdom, basically, it slowed again in the third quarter to 1.3% quarter over quarter. Even though there was an increase in consumer spending, investments were slightly higher. So we're seeing that slowing down. And then you look at the challenge of the Japanese economy. Their economy again confirmed another challenging quarter in the third quarter. Basically, with restrictions and everything else, their economy was down about 1.3%. And if you look here, now let's take a look at the domestic economy. So first of all, you all know that Jerome Powell will be having a second term in office. And so over the next set of circumstances here, in a second term, he may have to execute the reverse, which is giving priority to inflation at possibly the risk of sacrificing jobs. There's a real concern here. And you know, inflation recently was at 6.2% last month, and that's the highest in 31 years. And of course, if you look at the unemployment, the picture in employment, we're still 4.2 million jobs less than we were before the pandemic occurred. So there's a real concern there. So let's take a quick look at the outlook. What I have here, it's called the November Outlook for 2021. So first of all, as you know, the United States continues to face economic headwinds. You know, we have concerns with inflation, labor shortages, supply chain issues are impacting the economy. And the lack of supply chain is really creating higher prices, forcing customers to put off purchasing a lot of major products such as automobiles because of low inventories. And economists really believe that we're in the peak of the supply chain problem right now. And I hope they're right, but it's going to take at least another 6 months to improve. And the demand for truck drivers is still a major issue. You may recall back in January, February, March, I mentioned to you that the industry said that they needed to hire at least 1 million new truck drivers to be able to facilitate all the demands in this country. And that goes outside the country as well, such as the ports, shipping and receiving all across the United States. We need more truck drivers to be able to move product. Also, the government has and will continue to inject stimulus into the economy in the form of purchasing Treasury and mortgage-backed securities. And the Federal Reserve announced earlier in November that beginning this month, they're going to start dropping back $15 billion a month from both of those categories. And at the end of June of 2022, they're going to be at a point where they're not going to continue to stimulate the economy. And we'll see how that happens. And you know, many of you are concerned that inflation is still on everybody's minds. And we have a strong inflation. And the question is whether or not it's transitory or temporary. We hear this every day on the news. And will inflation stay high as it is in the past several months? Well, I think as we look at the fall right now, as we move into the weather picture, a cold winter would cause the risk of higher natural gas prices across the board, which could spike even inflation higher in the short term. But right now they're predicting, like in the West Coast, a warmer winter here. So I'm not sure what that means, but we'll find out pretty soon. The real key is getting inflation down to that 2+% range. In the past, we've always looked at 2%, maybe 3% at the worst case, but right now we're at 6% this last month, and we're still around the 5% on an annualized basis. And as I said earlier, the Fed will likely start tightening the economy next year because of the inflation picture, but we don't really see rates going up at all, probably till the latter part of 22 or sometime in early 2023, unless some of the things change. So what I wanted to do now is kind of talk a little bit about supply chain. You know, essentially the COVID virus has led to the current logjam at the ports that have rippled today, and thus urgent measures must be taken to alleviate the problem. So what is supply chain? Well, manufacturers in the United States and the rest of the industrialized world, you know, have long outsourced production of common low-cost products to China and other low-wage countries. And starting the early 1970s, companies began to outsource production of increasing number of more sophisticated products using multiple contractors to produce and assemble components. They felt that it could be done at a lot cheaper prices. A lot of these countries didn't have unions, etc. So companies could increase their profits in the United States by offshoring everything else. So essentially what we're seeing now is that the global supply chains are essentially prevalent in durable goods such as cars and appliances, technology products such as cell phones and computers and clothing, furniture and plastic goods. So a lot of the stuff that we buy in this country are coming in from offshore, primarily by ship. And if it comes in by airplane, it's going to be much more expensive. So why is supply chain management important? Well, you know what? An efficient, optimized supply chain is already so important to fulfillment for the customer orders but when managed correctly, it can also result in lower costs and faster production cycles. So supply chain management is really the umbrella for the entire process. So what really caused the problem? I mean, you listen to different people will give you different answers. Essentially, the COVID-19 problem was the trigger mechanism that began the logjam. If you go back and think about this, the domino occurred when Chinese plants used to develop and produce products began to shut down. And soon we saw disruptions everywhere. We saw labor shortages and transportation, costs escalating with log jams across the board. And the delays in the backlog and deliveries have become a major issue. If you think about it, we saw this happening across Asia as well. So that's a major issue that we have to deal with. If you look across the board right now in the LA and Long Beach areas, there's probably between 89 and 100 and some odd ships offshore loaded that cannot be unloaded. And all of these ships, if you will, represent about 40% of the shipping that takes place in the United States. So the loss of truck drivers and available trucks to move products has really created a huge bottleneck. And keep in mind, there are a lot of containers that are empty sitting there in the port area, so they can't even unload some of the ships as well. Now they're beginning to fine people $100 to $200 a day to get their containers out of there, and that's happening. And as you know, the government said earlier that how long will this thing last? What they're doing now is they're going to expedite the process by running 24 hours a day, 7 days a week until they can get this thing under control. And the real key here is they believe it's going to probably take a year to catch up. Now, you know, we're in the Christmas season right now, and there's a lot of products, toys, etc., that are off on these ships that may not get delivered, possibly until sometime in the first quarter of next year. So you'll have to buy and buy whatever's available on the shelves. The real key to supply chain, for those of you who follow that process, is looking at the best practices. And we're talking about the real-time and planning in terms of real-time planning that needs to take place, and also having contingency plans to deal with what I would call a lot of the disruptions that'll take place and what to do when certain trigger mechanisms occur. The other thing is we need to identify technology that can improve processes across the board. This has got to be end to end from beginning to the end of the process. A lot of these are still done very manually. And that's also hurting us. And we've got to move into the next stage, if you will. And then, of course, what's really critical is that suppliers have to have crucial supply chain communications between the customers and all the people involved in the process, the buyer, et cetera. And if that doesn't take place, there's a lot of delays that will happen. So we're not going to talk about the stock market, but what I wanted to do in the next slide is take a look here at the impact. Robert, the next slide.
It's up. Dennis, it's up.
Okay, there it is. Sorry. So let's talk about how the supply chain is negatively affecting stocks. So, few economists expect the supply chain problem to end by the end of this year. Shipping containers, again, have caused the bottlenecks all across the country. In some cases, the Navy is trying to help by unload some ships in the Ventura area to help out as well, like in the area of produce and things like that. So we're getting help from all over the area. One of the biggest problems we've had, and this is going to go on indefinitely, is the semiconductor market. And expectations basically for more manufacturing capacity at this time is really not likely. And it's going to continue to negatively affect the economy. We don't see this picking up until late 2022. I told you a month ago that Intel is building 2 new plants in Arizona. There's a group out of Taiwan that are going to invest and build 4 plants, some of them in Arizona. And then you've got a consortium with Ford Motor Company and one of the companies in Silicon Valley to build plants. So we're starting to build plants, and this could take 2 or 3 years before they're up and running, so that we don't have to rely offshore on semiconductors. The automobile industry has really been hit the hardest. We're behind about $230 billion in lost sales for car makers this year. And there's slumping revenue while demand for vehicles continues to rise. The logjam continues, especially with the port and congestions. There are companies, there are cars out there that have to be serviced, and unfortunately, they don't have parts. So you have to get a rental car or use another means of transportation because you can't get parts so you can use the vehicle. The other thing is, you look at Bed Bath & Beyond, which is a household name here, there's a lot of red flags. Their stock, their business has basically plunged 66% in the price of their stock. And again, that's because they have a lot of empty shelves and they really can't get product. There's a lot of doubt when they'll be able to get certain products in the stores. So they've really suffered quite a bit, along with other retailers. And the fundamental trend is that margins continue to shrink in the sector because raw material costs are continuing to escalate and businesses are dealing with logistics issues. So we're going to continue to see this. And of course, you got the high price of oil. And you probably wonder why. Well, the pipeline could be one aspect of it. But, if you stop and think about it, there's a lot of trucks that are not moving product in the area. Now, one of my friends who works for a firm here was in New York about a month ago and is flying home on American Airlines. And they normally have something like 12 trucks a day of fuel for the aircraft. They were down to sometimes to 2 or 3 trucks a day, which meant there were delays or a lot of flight cancellations. And that's going to continue until we can see more trucks and more drivers moving product. And of course, there's other industry exposures, like if you look at the housing market, both in commercial and real estate housing markets, what's happening now, the cost of raw materials is going through the ceiling, for copper and wood and everything else. So there'll come a point in time, once we get this under control, prices will start dropping and so will the inflation. So I think we're just going to have to wait and see how that plays. So let's talk about inflation. So in the month of October, inflation was 6.2%. It's the largest impact in 30 years. And it's across the board and everything. Consumer products, if you will, products rose across the board. You look at the food in the store, the prices are escalating. Here's what's interesting. In the month of October, the price of fuel went up 12.3%. And that's basically 59% since a year ago. So stop and think about that. That's how bad things are across the country. I talked to somebody in Dallas the other day and he was upset. They were paying, I think, something like $3 a gallon for premium. I told him you need to come to California. In San Diego, I saw a gas station the other day, it's $5.39 a gallon.
Mhm.
So for my friends in Florida and Texas and Louisiana, you guys are, you're doing much better than we are. Now, if you look at trade exports, it's been very strong. We're still over $208 billion per month, and it's a little bit lower than August, but it's been moving in the right direction. So that's a good sign. Here's the problem we have, the trade deficit. If you go back several months ago, before the pandemic really got started, we were running in the 40 to 50, maybe early 60s. Now we're just went out last month at $81 billion in the deficit. That really hurts our economy. So that's got to get under better control. Retail sales for the month were good. They went out about 638 billion, which is really a 1.7% increase. Now, if you look at October of 21 versus 2020, guess what? Sales were up 16.3%. So that's very strong data. And you remember how bad things were last year when you really couldn't go get out of your house to do anything. So it's improving. Now let's take a look at the employment picture. So the US economy created 531,000 jobs last month, and the unemployment rate dropped from 4.8 to 4.6%, which is very good. And as I said earlier in my presentation, there's still 4.2 million fewer jobs since February 21. The real key sectors here, and business and professional services for months now have been adding a lot of jobs. The government had some contraction, as you see there, but the real sector that's taken the biggest beating during the whole downturn has been leisure and hospitality. And we just saw another 164,000 jobs created. Keep in mind, a lot of retail jobs, restaurants, etc., have gone away and they will not come back. So some of these people are going to have to get redeployed. And in many cases, they're going to have to learn new skills to be able to get a job going forward. Manufacturing, which is really critical for us, showed an increase of 60,000 jobs. And of course, you saw retail and transportation. So all those are very good for the month. And like I said, we're moving in, we have November and December, and that's it. So you should see a lot of part-time jobs coming out of places like the retail sector, etc. There should be a lot of jobs and a lot of people.
Dennis, if you would unmute yourself.
Sorry about that. Can you hear me?
Yes, good.
Tony, I was going to say, you'll see a lot of part-time jobs over the next 2 to 3 months take place, and those jobs will kind of go away in January. So the idea now is to move a lot of product in the marketplace. Looking at California, California created almost 97,000 jobs, which is a good month. Now take a look at this. The unemployment fell to 7.3% from 7.5. If you remember, I said earlier in the year that when the economy goes south, California is the last to go. And then finally, we're the last to come out of the recession. So we've got a long way to get to 5.9% if they think that's doable by December 30th. That means you're going to have to hire a lot of people, full-time and part-time, in the month of November and December to be able to get there. So we'll see what that happens. The federal employment report will come out probably tomorrow, and I'll have data for that next month. Just the categories, they're relatively flat. I mean, again, administration was up a little bit. The real key was leisure in California. Again, that's your hotels and your restaurants and things of that nature. So that's where you're going to see more jobs being created. So let's take a look, for example, at interest rates. What I'd like to talk about here is the fact is, I mentioned earlier, the Federal Reserve is going to continue to monitor the level of interest rates. And for example, usually when you get down to about 3.5%, they look at the employment picture as being full employment. And when that happens, we should start seeing rates start to inch up. They don't believe that the rates will go up until late 2022 or earliest or 2023. So I think we're going to be safe next year for the time being. That's going to continue. As I mentioned earlier, the tapering is going to continue with major policy. The idea is to get it down to where they're not going to be able to inject money into the marketplace starting in the end of June of next year. And we'll see how that works unless we go into a recession. Mortgage rates inched up a little bit this month to 3.12%, a little higher than it was in September. The manufacturing index took a hit this month because of the bottlenecks and supply problems. It dropped down to 60.8, but we're still over that 50, which is the benchmark level. And I've said many times, if you're above 50, we're in good position. If you drop below 50, we're either in a recession or heading into a recession. Now, factory orders are critical for manufacturing. And what we saw here, it was a slowdown in October. And new orders dropped to a 16-month low. And again, this is delay in raw materials. Again, supply chain. So supply chain has its hands on everything. And it's going to continue until we can solve that problem. Small business confidence level, basically the optimism dropped down 0.9 of a point. So we're around 98 right now. And the benchmark is really 100. So we're very close to that area. And we've been back and forth between 98 and 102. So we're okay from that perspective. Consumer confidence rose for the first time in 4 months, which is good. It's up to 113. So people are feeling a little bit better about what's going on. They're being able to get out more. You're seeing more people traveling. So there's more optimism going forward, which is very good for the economy. In the area of crude oil prices, this is very interesting. When I cut the date off, like late last week, the price of West Texas Intermediary was down to $78.28. It's down $4 from October. The concern we have is twofold. Number one is production levels coming out of the Middle East. Russia and everybody else has to raise production levels. And number two, we need more drivers and trucks to move fuel around to every place. So there aren't any games being played. They can only move the product if they have the vehicles to get there. So we're still struggling in that area. And as more and more people start driving, like over Thanksgiving weekend, whether they're flying or driving, there's more of a demand for the fuel. And it's the same thing around the world. So as things pick up, there's more of a demand. And unless we see this, we could see oil prices jumping somewhere around $90 a barrel sometime early next year. So and hopefully that won't happen. What I'd like to do now is talk a little bit about the housing market. So total housing basically fell 0.7 of a point last month. And, you know, as we start moving into the latter part of the year, you see a slowdown because of the weather, number one, and number two, because we're moving into the holiday season. So it's slowed down. Family homes, single family homes dropped 3.9%. So we'll see. But the demand is clearly not the problem. If you look at new home sales, for those of us that live in California, Southern California home prices basically rose 14% in October. In Los Angeles County, the prices rose 10.5% for the midpoint to $790,000 for the average home. But sales were down by 0.9 of a point. So we're seeing that slowing. If you look at Orange County, for those of you from Orange County, the increase in the midpoint was of 15.7%. And now the midpoint of a home is 920,000. Sales were down 13.6%. And lastly, we have San Diego, which the midpoint rose 13.8% to 740, but sales were down by 12.4%. So we should see some sales slowing down in these months until probably sometime, I would think, the latter part of January. That's just the basic time frame. So that's what we see happening in the market. We still have a very strong housing market here and across the country. And existing home prices, sales basically rose 0.8 of a point, which is good. And over the last year, they've been up substantially. So the real estate market for real estate is very strong and will continue to be strong for the time being. As I mentioned earlier, productivity reports come out once a quarter now, not every month. So the non-farm business sector labor productivity decreased by 5% in the third quarter of 2021, which is not good. However, there's been an increase for work being done by employees by 1.7%. Again, we're still the fact that we have too many jobs out there. There's still around 10.2 million job openings in this country. Now, some companies have held off on hiring because we're coming to the end of the year. And we have a lot of positions, Bill Swan, that can't be filled because people lack skills. And Dan Ruckman, we've talked about this. So there's going to have to be some shifting here on training and development as we move into next year. The good news is on company displacements, it's been 5 or 6 months since a company in the United States had a massive layoff. So that's good news. There's some layoffs taking place, but nothing that we've seen over the last 3 to 4 years. Now let's move into the merger and acquisition marketplace. Here, we're seeing a lot of activity. The market this month boomed. If you look at Coca-Cola, they had initially invested 15% in body armor. They're buying the whole company now for $5.6 billion, making it the largest brand acquisition to date. Those of you familiar with DoorDash, they're buying Finnish food delivery company Wolt for $8 billion. They're expanding their portfolio in the marketplace. And basically, they're becoming one of the largest companies in commerce delivery platforms across 23 countries. If you like chocolate, you're looking at Hershey's is buying a company called Dots Pizza Pretzels, and that's going to be an expansion in their marketplace. And this is going to be about a $1.2 billion deal. They will now increase 55% of their marketplace is going to grow based on this acquisition. You have a company called American Eagle. They're acquiring Quiet Logistics for $350 million. The idea here is to increase their coverage in robotics in places such as Boston and Chicago and Los Angeles, et cetera. So the robot business is again continues to grow. In the technology space, most of you either have McAfee or you may have a form of Microsoft, or you have different types of security packages. Well, McAfee, as you recall, was acquired a few years ago by Intel, and Intel, as usual, didn't know what to do with them, so they spun them off. They were on their own and just got acquired by a company called Symphony Technology Group for $4 billion. The company McAfee was started in 1987 by John McAfee, and in the antivirus business place, and they've been very strong for a long, long period of time, and they'll continue to be strong. So that's a big acquisition for them. And the FTC basically approved the final deal with Verizon and TracFone. That's a $6 billion deal. And it's worth, basically it's positioning Verizon to be one of the largest prepaid service providers in the United States. So Verizon continues to expand their business portfolio. All of you are familiar with General Electric. When we were all a lot younger, GE, when you looked on television, you got to see GE buying a refrigerator, sewing machines, whatever they had. Well, over the years, since the 70s, they began to divest themselves in different product lines. So they're no longer involved in washing machines and dryers and everything else. They've come up with a major statement here. And what they're going to do, they're going to break the company up into 3 business units. One is going to be aviation and defense, healthcare, and energy. The plan is to stay focused primarily in the area of defense business, because that's where they think they can make the most, both in classified and non-classified areas. So by early 2023, or maybe as early as 2024, those other business units such as healthcare and energy will be gone. It will no longer be part of their portfolio. Johnson & Johnson, which is a household word, is reevaluating their strategy in the marketplace. They've been the world's largest healthcare provider. And what they're going to do now, they're going to spin off a couple of their lines of business, such as a consumer health business. So what else is taking place in the economy? Well, you know, of significance right now, all of you have heard the word artificial intelligence. Well, this is critical to the US. And services now is quantum computing, biotechnology are among the fields the nation's counterintelligence chiefs are very concerned about, and we must sound either from the standpoint of ransomware or basically just trying to take them down so they can't operate. So this is something critical, and we're spending more money, time, and effort to protect those assets. You may recall some time ago, Hertz went into bankruptcy as the pandemic began to expand, and they sold off a tremendous amount of their vehicles for cash flow to keep the business afloat. Now what they're going to do is buy 100,000 Tesla electric vehicles as part of their inventory, so they can cut costs basically and move in this direction. We've all heard about the issues taking place in China with different technologies. Well, Yahoo is the 3rd major company tech platform to exit China. The problem you have here is they'll no longer operate in the country because China has tightened data and privacy regulations that are making it almost increasingly difficult for US companies to operate there. All of you are familiar with Zillow, and some of you independently have been involved in flipping homes. Well, Zillow went overboard. They basically have offloaded 7,000 homes that they can't turn. This is about $2.8 billion. So they're trying to get through this inventory, and essentially they've had write-downs of $569 million. And essentially they're going to reduce their workforce by 25%. They were not specific in terms of numbers, but they're having a real problem now in the flipping business model. So they're moving away from that. I talked a little bit about supply chain earlier. One thing I wanted to talk about is the farm, the agriculture business, which is really suffering, especially in the state of California. The port log jams leave the state's product with nowhere to go to ship products, to ship crops. And the farmers are struggling to export product. And a lot of this product basically will have to be destroyed. So last month, if you can believe this, 80% of scheduled shipments from the farm industry were canceled and had to be rescheduled. So there's a real concern for that going forward. So again, there's another area where supply chain has had reared its ugly head. The Harbor Commission recently approved a major program to move towards electric vehicles, to reduce emission along the lines like that, to move to electric. And we're going to see that happening. The clean truck rate, they're expected to spend $45 million over the next couple of years. And they hope by 2035 that they'll eliminate all emissions from trucks by being all electric in that whole area. For those of you who are familiar with a company called Toshiba, they've been, over the years, have bought a number of American companies. They've decided to split their company into 3 business units like the other American companies. If you can imagine that Toshiba's been around for 140 years. And so what they're doing now is they're going to split it up into 2 basic business units that'll be public, and the rest they'll begin to sell off the components that no longer fit the strategy. I mentioned Ford Motor Company. Ford is the first company in the automobile industry to move into a different vertical marketplace. What they're going to do is they've set up a partnership with Global Foundries in Silicon Valley, and they're going to develop chips for the shortages strictly for Ford. So Ford is going to work with one particular business unit now to get their components, because a lot of the trucks are either sitting idle or production is slowed down because they don't have chips to support the program. So that's kind of what we have. What I'd like to do now is open it up for question and answers. Okay, Robert.
Yeah, Dennis, we'll stop the recording and then we'll open it up.
Yeah.